One of the reasons we chose the Dynamic Fund has an amazing track record. It's around since 1989. It's achieved almost 11% per annum on average over that period of time, over 30 years. It will always go up and down in value. It's gone through really bad years. Check out the investment strategy again. I will go through those bad years with you. Like if you look what happened in 2008, the financial crisis, but it was up a few years later. So I can see stock markets collapsing. I can see them increasing and decreasing in value, but you'll be getting that average over a long term. Oh, thanks very much for the kind words. The best managed fund, I think, is what I would view to be a really good managed fund is the Zurich Dynamic Fund, which in the Ask Paul investment strategy. Again, on my link tree, go check it out. And taxes covered in that as well. It's exit tax at 41%. So I hope that helps. Peer-to-peer finance is a good option as part of an overall investment strategy, a small portion of your portfolio. You know, I've done a few videos before already with Jamie in relation to what Flender do. You'll find them on my stories and also on my IGTV as well. I think it's a good option. Peer-to-peer financing, especially in the current environment, is a little bit more risk than some people may be aware of. So it's important to read the small print and it's important to use a company that you're really, really comfortable for. And that's why I would kind of recommend looking the Flender direction because I trust the lads. People ask me this, why am I doing Zurich rather than a trading platform or picking up EFTs or picking up passive funds? Because it's done for me by Zurich. It's over 400 companies invested in. It's doing it since 1989 with a 10% average return. Don't think you're going to beat that. You can change at any stage. Just let us know. You can up your regular contribution or decrease your regular contribution. We try and get people to commit to at least the same amount baseline. Wouldn't go below a certain figure, but you can top up at any stage you want and then bring the figure back down if you wish as well. Just reach out to the team. Send a quick email to questions@askpaul.ie. Investment club member in the subject box, and let us know what you think they're doing, and we'll execute it for you ASAP. Really depends on what else is going on in life. If you're a young single living at home, I think it should be up towards 40% if you're really going to look for maybe going out on your own or start your own business. If you have kids, you're married, 15 to 20% is probably all you can manage at this stage. The funds are easily accessible. You pay a little bit more to Zurich in order to get them easily accessible, about 0.25% a year. But that means you can access them at any stage penalty free. Now, obviously, it might be up or down in value, but there's no penalties on the contract. So some people know if you get into the investment club, you put in a lump sum of $7,500 at the beginning. Zurich reduced the annual management charge by 0.25%, which is a great saving, especially if you're saving for maybe 10, 15, 20 years. If that's the case, you will have exit penalties in the first 3 years because you reduce the charge. In that case, with that contract, if you put the $7,500 lump in, the exit penalties are 3 to 1. So 3 to 1, do that properly. And that's based on 3% in year 1, 2% in year 2, and 1% in year 3 on the penalties. Wrap up with that question. Obviously, if access is important to you, just take the slightly higher annual management charge and don't put the $7,500 lump sum in. So I hope that helps. Yes, you absolutely should. The reason is that I'm trying to get you a 6% return over probably 5-year period. And that's going to have exit tax on it, obviously, where you're paying probably 6, 7 or 8% or more on your loans. It doesn't make any sense. Clear the loans. Get your emergency fund set up, $1,000 or $2,000, set aside the emergency, probably credit union, post office, somewhere like that. And then join the investment club. I hope that helps. I look forward to working with you in the future. It's one of my preferred asset classes is property. Really good rental income, especially if you're considering buying in Dublin. I think it's going to be a complete bubble here for the next, foreseeable future. It's going to be like a mini London, in my opinion. It's really, really, really good. However, invest in property, things can go wrong fairly quickly. Usually if you're borrowing, it's probably the major concern. So if you're borrowing, the idea is that you try and clear your borrowings as soon as possible. So your income and the rental income should be used to get rid of your lending as quickly as possible. And that means passive income comes in. Usually the bigger the lump sum you have to go to the deal, the better that is as well. If you're looking to borrow, the banks will generally only borrow up to 70% of the loan of the property. For mortgage, you have to have the other 30%. I'd prefer a 50-50 ratio in fairness. We have helped people in the personal consultations. We have helped people identify what the kind of sweet price is, the sweet point is rather, in relation to where to invest, how to invest, whether to use finance, whether to use your own cash, and what that kind of good ratio is. Very straightforward enough. I invest €500 every single month into the Zurich Dynamic Fund. You get my investment strategy, why I'm doing it, how we're doing it. You download the free guide on my Linktree, book in for the consultation with the team, and they can set you up on it if you want. It's €149, and that gets your consultation with the QFAs and the team, and they help you with your implementation. They send you the regulation documentation and compliance documentation, and get the account set up at Zurich for you as well. So I think it's really good value, and ultimately make sure the risk suits you.